Hi everyone, this is Kishore Purswani. Welcome to this fourth video in the series of Basics of Investments. In the first three modules, we discussed various basic fundamentals of the investments. Let us have a quick recap. In the module 1, we discussed where, why and where to invest. We discussed on the various options and tried to conclude that stocks is one of the safest option which delivers good returns. In the module 2, we discussed how to invest in stocks. We touched upon the primary markets. We compared the difference between primary and secondary markets. And in the third module, we discussed whether the investments in primary market through IPOs is safe. Today, we'll be discussing more on the IPOs. The IPO insights. We'll be looking at the analysis of the IPOs of the past few years. If we look at the data of 2015 to 19, 121 companies got listed in this period up to December 2019. Out of 121, only 81 listed with some gains. That is 67%. Rest 33% listed with a negative bias or below the issue price. So if you are lucky and you had invested in the stocks in those 67% which listed with the listing gains, you could have made some money. Now if we look further the trend of the prices of these 81 companies just after 1 year. Why we are taking 1 year? Because some of the investors have a tendency to stay invested for 1 year because there is a clause called capital gains which acquire long-term capital gains come into effect only if the stocks are sold after 1 year. So most of the investors try not to book profits within 1 year. And if we see the trends after 1 year, out of these 81 companies, only 57 companies were trading above the issue price. That is 47%. So if you look right from the day of listing to say 1 year after the day of listing, only 47% of the companies gave some positive returns. Rest 53% companies after 1 year were trading at a price which was below the issue price. Why such fluctuations are there in the newly listed shares? And if we see the analysis or the trends, some stocks are listed above the issue price, they continue to rise and continue their upward trend. IRCTC was one example. Whereas there are certain stocks which list below the issue price and continue their downward trend. In the last video or the last tutorial, we saw the example of Spanna Spurti. There are many such examples. While there are some of these stocks which fluctuate, rise, dip, rise again. So it depends on companies to companies. The price movement basically depends upon the confidence the investors have in the company, the confidence the investors have in the management or the fundamentals of the company. And of course, very important is the market position at the time of listing. It plays a major role sometimes, as we had seen in the SBI Cards. So what should we do with the newly listed stocks? Should we sell on listing? Because we have a fear of losing the gains if they are listed with some positive gains. And if they are listed with negative, that is below the issue price, we are fearful of incurring losses, further losses. Or should we buy more? Either to average, or if it is a good company listed above the issue price, to acquire more stocks, because in the primary market we got very few, maybe 1 or 2 lots. or we should continue to hold, the decision becomes very, very difficult. We will see in the ensuing slides why it becomes difficult. We had discussed in the previous sessions also. There is no trading history. There are no trends available of the newly listed companies. So even for the seasoned investors, it becomes very, very difficult to predict the movement of the stocks. So let us understand two levels, two psychological levels. And we understand these two psychological levels. They will come handy when we discuss more about the secondary markets also, or investing in secondary markets. These two levels are called support and resistance levels on a price chart. These are the two levels which restrict the stock price movement. On the lower side, support; on the higher side, the resistance level. Support price is the level from where the stocks refuse to slide further down, whereas resistance level is the level from where the stocks refuse to go up, and they normally fell back from the resistance levels. There could be, in long run, multiple support and multiple resistance levels, because if the stock has to go up, the support levels will not remain same. The support levels will keep on changing, and similarly if the stock is falling down, the resistance level will continue to fall down. Now let us look at the chart of ICICI Securities. The issue price was 520 rupees. It got listed much below the issue price. It fell down considerably at very low levels and found some support at a level of 200 rupees. And now it is finding a resistance around the issue price. And if you look at the graphs, you will see there's a trend. That means support price was continuously changing. It was finding higher supports, and now it is finding a resistance at the issue price, because as soon as the stock tries to reach the issue price, there is a selling pressure from the investors who got the stocks in the primary market, are holding it. They try to exit near the issue price. This is a psychological barrier basically, and we see if a stock gets listed below the issue price, there will be maximum selling around the issue price if the stock continues to go up at some time, as we have seen in the case of SBI Cards. So these support and resistance levels are the psychological barriers. We as an investor get attached to two levels. One is the highest level we have seen in the stock's journey. We wish that we should exit at the highest level, but it is not possible. It is quite possible that by sheer luck, that you decided to exit and you got the highest price, and then the stock slipped downwards. But if a stock has seen an highest price and is continuously falling down, we should not get attached to the highest price. Take a wise decision. Come out of the stock to hold on to the profits which we are holding, or to prevent from further losses. Similarly, the other attachment level is the issue price. If the stock is coming down, has listed below the issue price, we tend to get attached to the issue price, and we see, or rather we want that we should not incur any losses, and we would like to sell at the issue price. As a result, we may incur further losses. So we should be very careful of these attachments in the market. Now, if we discuss more on the support and resistance levels, the more the number of touches By number of touches means the more the stock is touching number of times the support level or the resistance level, the more it is proven that this is the support level or this is the resistance level. The higher the data, that means the spread of the data for a large period, will give a very good analysis of the support and resistance levels. But mind you, this is all post-mortem. Yes, looking at the past data, we may be able to predict that these are the support levels and take some decisions, but that has to be established first. And in primary market, since the data is not available that easily, means not for a very long period data is available, so finding the support levels and resistance level also becomes difficult. Now let us look at the chart of the SBI Cards. The issue price was 755, got listed at 730, fell down further, touched a low of 496 rupees, found some support at 500 levels, and since then it has still to find a resistance level. It is continuously on an uptrend, and if you see further the volumes, if you study the volumes, you would find that around the issue price there have been very large volumes involved. That means many investors would have exited at the more or less around the issue price, but the stock is continuously going up. And on 15th of October, when there was a huge fall in the market along with the foreign markets, this stock further went up. It went up to 890 levels from the issue price of 750 or from the low levels of 500. So it has given very handsome returns to those investors who have patiently held these stocks or even bought more stocks at the low levels, if not around 500, but definitely below the issue price. Now if we look at the very recent trends of Chemcon Speciality, which was recently listed on 1st of October. The issue price was 340 rupees and the stock got listed at a handsome price of 731 rupees. Yes, it is slipped 150 rupees on the same day, came down to 584. Now here is the importance of the attachment. If we are attached to 731, we would not have exited at 584 also. And then the stock has seen the continuous downtrend and is trading around 405 rupees recently on 15th and 16th of October. So from 584 it has come down to 405 rupees. If as an intelligent investor, after seeing the levels of 731, had we applied some stop losses or taken some decision even to exit at around the closing price of 584, we would have held on our gains, held to our gains and made some good profits. Now similarly look at the trends of computerized management systems. The issue price was 1230 rupees. It got listed at 1518, went up to 1530 plus levels, slipped to 1402 levels, and it has further come down to 1341 or so on 15th and 16th of October, around these levels, 1330 to 1340 levels. So what important is from the lessons of these few graphs or few studies, that we should not get attached to the highest price or to the support price and take our decisions accordingly. Another interesting case is of Root Mobile. This was issued at a price of 350 rupees, got listed at 708, more than double, went up to 735, fell down on same day to 651. If had we exited, we would have been repenting, because the stock went up to 988 levels in a matter of 3-4 days, 3-4 trading sessions. But then, since then, it came down further. Now, what happened on 16th of October is very interesting. And all of us should know this. On 16th of October, the stock fell down by almost 10% with a closing loss of around 7% from the previous price of 15th October. Now, why this sudden fall when these markets went up from 15th to 16th October? 15th October there was a downfall in the market. 16th October the markets recovered to a reasonable extent, but this stock fell down by almost 10% and closed with a loss of 7%. The study shows that the anchor investors had booked or exited in a large quantity. Now, who are these anchor investors? Anchor investors are those investors in whom the management has shown some confidence, given them preferential allotment, but the SEBI rules prevents them from selling these stocks from the date of listing till a period of 1 month. There's a cap. There's a lock-in period. They cannot sell stocks for 1 month. Normally, the companies show confidence in these anchor investors that they will be holding these stocks for a larger period, for a longer period, and that is why they give them preferential allotment. But in this case, whatsoever could have been the reasons, the anchor investors chose to book profits on 16th of October because exactly on 16th of October or 15th of October, the 1 month lock-in got over, and 16th of October they got a window to book and they booked profits in huge volumes, and because of the huge volumes, the stock fell down. So these are the few points we should always keep in mind. We should be always vigilant that as what is going to happen. So if we look at this study, what we have seen from 2015 to 2019, looked at some of the charts. So what are the learnings from this analysis? The very important learning is that we should not bid in all IPOs, but should take a judicious decision and bid selectively, not in all IPOs. We should do our research completely. And if we are getting good listing gains, much above or more or less equal to our targeted gains, because if we have taken a decision, we should have taken a decision keeping in mind that the stock will get listed with this level or that level, and if we have achieved those levels, we should try to book profits. Of course, we can continue to hold and buy if our confidence in the company or the management is strong, and if we feel that the valuations are low and the stock will find its right valuations in the times to come, we can definitely hold and even buy, because in the primary markets we could have got 1 or 2 lots, very less quantity, and if we want to really make some money, we should have some reasonable number of shares in a company. Very important is that in spite of our research, if the market situation was adverse or our research was wrong and the company has listed with a price level below the issue price and the trend indicates that it is going to go further, then we should not shy away from booking losses. A small loss is better than a huge loss. We have seen the cases of Chemcon, we have seen the cases of Root Mobile, we have seen the cases of Computer Age Management, and there are many other such cases where stocks have listed at a very handsome price, then have slipped down even below the issue prices we saw in the very first slide. We should take advantage of the investor emotions. Advantage means if investors are greedy. Other investors are greedy, we should take advantage of it. If other investors are fearful, we should take advantage of it and invest in good companies. And very important is, as we have been discussing on every chart, that we should not get attached to the highest level price or to the issue price. These are psychological barriers. If the company is good, it is definitely going to give you good returns in a long period. But unfortunately, if the company is not a good company, it's better to exit from the company. Now, what experts have to say, let us listen to them. Warren Buffett says, I will tell you how to become rich. Close the doors. Be fearful when others are greedy. This is what we discussed. Be greedy when others are fearful. And similarly, Peter Lynch. The trick is not to learn to trust your gut feelings, but rather to discipline yourself, to ignore them. Ignore the gut feelings. Stand by your stocks as long as the fundamental story of the company hasn't changed. So these are just two examples. These Warren Buffett, Peter Lynch, and many other investors who have made money in the market have shared their learnings by way of their quotes or what they have written in their books. We should study them, learn from them, implement them, execute the learnings, and then definitely we'll be getting in the markets. If you have liked this video, like the learnings, please do like, share and subscribe to our channel. And if you have missed the 3 sessions earlier, you can visit us on the YouTube channel. We'll be sharing the link with you. Thank you very much. Looking forward to your valuable suggestions and feedback so that we can come out with videos of your interest. Where you are interested, please do post your questions and write down to us so that we can come up to your expectations. Thank you very much.